Hello everyone, welcome back to my channel. In this video we shall continue the part 2 of our Fibonacci course. I dropped the part 1 of the video last week and this is the part 2 of the video. I had to divide the video into two so that it will be too long. As always, all the information here are my personal opinion and not a financial advice. I have about 4 different pairs here on my watch list which I want to use as an example, as a practical example. And don't forget, all these pairs, these are the pairs that have already played out, so that you will see what I'm talking about. What I'm talking about, we are going to use the past chart as an example. So the number one chart we have on our watch list here is Australia Japanese yen daily time frame. Let's go into the chart and bring out the Australia JPY daily time frame. This is Australia JPY daily time frame. So let us zoom the chart to see what happened. What really happened here was we are going to look at this chart here, and here. Like I always say, look at this high here. This particular high is equivalent to this high on this oscillator. Then look at this high, is equivalent to this one. Now what happened here? When the market was making, this is regular bearish divergence. Let me zoom in so that you see what I'm talking about. This is regular bearish divergence. The price was making higher high, as in this high is it break this is also high, this is another high, but this particular high, this particular one, it break the previous resistance. Now that's to tell you technically the price is making higher high. But as it's making the higher high, let us go and check our oscillator. Well, if the oscillator is following the suit as well. But look at what happened here. This particular high, you can see here, the oscillator is not making the higher high as well. Instead, the oscillator is making lower high. That is, as in this low is lower than the previous one, as in as the market make higher high, the oscillator is expected to make higher high as well, but rather the oscillator is making lower high. In a situation like this, it's telling us that the price and the oscillator, they are diverging from each other. There is a disagreement between each other. They are disagreeing from each other. In a situation like this, it's telling you indirectly that a reversal is on the way. And don't forget our confirmation candle. When we see a situation like this, this is the candle that gave us the confirmation. We initiated a sell position here, and in a situation like when you initiated a position like this, your ID stop loss will be few pips above this high, and look at what happened. The market went down. You can use any oscillator that you prefer. It's either RSI, which is relative strength index, or MACD, anyone that is comfortable with you. But I usually use RSI, but I also use MACD as well. So now that the price has went down, and remember that the divergence, like I always said, is a pullback strategy, but it's a very strong pullback with a high winning accuracy. So now that the market has pulled back here now, and we know that the main trend here is uptrend, how do we get an entry? How do we get an entry here so that we can continue the trend? In the part 1 of this video, I've already explained to you the use of this MACD. So if you are confused this one, please go back and watch the part 1. So now we are going to draw our Fibonacci. Remember, the trend is uptrend, and if the trend is an uptrend, you are going to draw your Fibonacci from the low to the high. So I drew this particular Fibonacci here from this low to the high. I believe by now you must know how to draw the Fibonacci. If you don't know how to draw the Fibonacci, please go and watch the part 1 of this video. So I've drew my Fibonacci here to know where I'm going to take profit and where market will likely bounce, so that I can continue with the trend. And look at what happened now. The market bounced at 61% of Fibonacci. Are you using it now? The market bounced here haven't bounced here now, it's telling us that the market is about to continue the uptrend. And look at what happened in a situation like this. Once I see a bounce on any of this level, I'm going to place a buy. Since the main trend is uptrend, because the divergence is just a pullback, I'm going to initiate a buy position. My D stop loss will be that Fibonacci level, that where the market bound. My D stop loss will be few pips below the level, and this is where the market bound, 61 level. My D stop loss will be few pips above here, and look at what happened here. Boom! Since then, the market has been up. Look at when the uptrend continued. Uptrend continued on the 7th of March. No, July 3rd. I mean, sorry, the July 3rd. That is when the uptrend continued. Look at the date here, 2006, July 3rd. That is the uptrend has continued, and since then the market has been up. I believe you understand what I'm talking about here now. The market has been up, and market will surely get here will be the first take profit, the recent resistance or recent high. This will be the first take profit, and most likely it may continue the uptrend. And if the market get to this level, and if it's unable to, but nobody know what the market is going to do. Like I said, all the information here, they are all my personal opinion, not a financial way. But let's assume if the market gets to this level, the previous resistance, if it's unable to continue the uptrend, then we look for a bearish candle here. We are going to initiate a sell, but nobody know what is going to happen at because this movement has not been completed. The market is expected to get to here first. Secondly, it can even go beyond this level, break the recent resistance, and continue the uptrend. So that is it about Australia pair. I use a bullish uptrend as an example here. Let us look for another example. I'm going to look for New Zealand US dollar. I had a bearish divergence on this side. I haven't used the uptrend as an example. I want to use New Zealand now. I want to use New Zealand as an example because that one is a bearish trend. The overall trend was bearish, so it now gave us a regular bullish divergence. So once we are done with the bullish pullback, we continue our uptrend. So let us go to New Zealand. Let us zoom in a little bit to see what I'm talking about. This is New Zealand. This is the New Zealand. This is regular bearish divergence. How is it bearish? Look at what happened here. The price here, I mean regular bullish divergence. The overall trend is bearish. So when we see a bullish divergence, it tells you that the market wants to pull back. So when the market is done with the pullback, the trend will now continue. And if the trend is continue, there is high probability that the price will get to here or go down below this level. So let us look at what happened in this case of New Zealand. Look at what happened here. The price was making lower low here. This is the previous low. The market came down and break the support and make a new low here. That's to tell you that the price is making lower low. But why the price is making lower low? Let us check our oscillator. If the oscillator is making the lower low as well. This is the oscillator here. This is the RSI. See, this is the previous low, and this is another low. Now, what happened here? The oscillator is making higher low. It's making higher low in the sense that this particular oscillator, it did not go down with the price. If the oscillator go down and break this level, go down beyond this level, then we don't have any divergence. But in a situation like this, we have a regular bullish divergence. Like I haven't got the regular bullish divergence. We use this candle as our confirmation candle to enter. Having entered from here, your ID stop loss will be few pips below this low. Ride this trend to this level. Once you initiated a buy position like this, you draw your fibs. You know, this trend is a bearish trend. The overall trend here is a bearish trend, and in a bearish trend, you draw your Fibonacci from high to the low. Like I said, if you don't know how to draw this, if you are confused about the Fibonacci, how to draw it, go and watch my part 1 of this video. So I often draw my Fibonacci like this. I will now be checking the key level, all this key level 23, 32, 50, 61. So the market just closed above 61 slightly. This is the 61 level. This is 61 level. This is the 61 level. The market closes above this thing slightly, then it range a little bit before it start the downtrend. And let's see the outcome of this. Let's see the outcome of this trade. This is the previous support, as in this level. So let's see what now happen in the future. Price still came back to this level. Okay, since the price has not coming back to this level, but it came down to this level. Initially, we are expecting the price to get to this level or even go below this level. But if you get an entry, if you get a sell position from here, and the market has gotten to this level, if you start to see signal a reversal, you can take your profit. And if you initiated a sell position from this level down to this level, now I think it's not a bad trading idea. It's not a bad entry. So that's it about New Zealand US dollar. Like I said, I don't want the video to be too long, but let me just add one more example to it. We have Australia CHF, that is Australia Swiss francs daily chart. This is the Australia CHF daily chart. Look at we are working on this one here and here. Look at what's happened here. The price making higher high here. This is a resistance. The market pulled back and came back to this level and break the resistance. You can see this particular candle, it closed above this. This is the previous resistance level. Let me highlight it properly so that you can see what I'm talking about. Yes, this level is a previous resistance. This candle is a previous resistance level. What happened? This is that is 0.567725. It's a previous resistance level. The market pulled back a little bit and went up and break the previous resistance level. But what happened now when the market now break the previous resistance level, it make a higher high. But let us check our oscillator, if the oscillator follow this. So this is our oscillator. This high here, this level is equivalent to this level, this one, whereby this one here is equivalent to this one. And look at what our oscillator is doing. Oscillator did not follow the suit. I did not follow the suit. So we now, in a situation like this, we have gotten a sell setup. In a situation like, what are we going to do? Look for a confirmation candle. This candle is our confirmation candle. And for those that are confused about how I arrive at all this confirmation candle, I have a video here that explains divergent trading system from A to Z. So if you are confused about all this confirmation candle, how I arrive at all this thing, please go and watch the previous video on divergence, or on how I talk about divergence. So this candle is my confirmation candle. I initiated a sell. I haven't initiated a sell. I will now draw my Fibonacci. This is the main trend is uptrend. So we are going to draw our Fibonacci from low to the high. I haven't drawn it like this. We now be looking for a bounce on all this level. We have different levels here. We have 23, 32, 50, 60, and the 100 level, which is the down one like this. This is so all what we need to do. So we're looking for a bounce. Remember, if you have been watching my video, if I did not use SMA 20 as my take profit, I use a Fibonacci level. Now, look at what happened here. The market came to 23 level here. Look at it. This is the level. Let me remove all this so that you see all these things very well. You see it. This is the level. This is the level where the market bounce. As the market bounce here, once the market bounce on any of the candle here, any of the Fibonacci number, when the market bounce here, you initiated a buy. Your ID stop loss will be few people below the load from there, and look at what happened. Boom, we ride it up, even break the previous resistance, and it's still shooting up. So that is all about Fibonacci. Like I said, I don't want the video to be too long, so I urge you people to go back to your chart, because the lesson is a belief. Go back to your chart, initiate this same idea. Number one, if you go back to your chart, go and study your chart. Spot a divergence. When I haven't spotted the divergence, study how the market reacts. When the market reacts, you now draw your Fibonacci. The part 2 may be a little bit tough for you, but go and watch the part 1 of this video so that you understand the video very well. Watch the video and know how to draw your Fibonacci, and look at how market reacts at the key level. If not, because of the time, we can go on and on and on to bring up to 20 examples, a practical example on how this thing reacts and how the market play out and everything. You see the before and after of all this thing. So I urge you people, for those that want to take their financial journey seriously, I urge you people, go back to your chart, go and read all the charts. First of all, your first job is to identify Fibonacci, check how the Fibonacci move, and draw your Fibonacci. Your first step is to discover a divergence level. When you discover a divergence level, you now see how it move. You now draw your Fibonacci, how it bounce on Fibonacci. If you see a regular bearish divergence, it's telling you that the main trend is uptrend. You just want to pull back. After the pullback, you ride down with the trend. But if you see a regular bullish divergence, it's telling you that the main trend is downtrend. After the pullback, if you hit a Fibonacci level or a fair value gap or a moving average, from there the market will continue the downtrend. So that is all about the Fibonacci level. And please, if you have any question, feel free to drop your question here. I will be glad to help you. Thank you very much. See you in the next video.